Greetings, stock enthusiasts. Another trading week has begun, and we are excited to delve into the latest financial and stock market news. We will provide a comprehensive overview of the most significant events shaping the markets this week, as well as an in-depth analysis of the previous week's developments. Additionally, we will be examining 3 of the hottest stocks making headlines so you can stay ahead of the curve. It is crucial to acknowledge that the information shared in this podcast is for educational and informational purposes only and should not be treated as financial advice. We encourage you to conduct your own research and seek guidance from a financial advisor before making any investment decisions. We deeply value your feedback and support, so please don't hesitate to hit that subscribe button, leave a comment with your thoughts on this week's report, and give us a like if you found the information helpful. With that, let's dive into the exciting world of stock market news and analysis. Last week's stock market saw the S&P 500 and Nasdaq Composite each experience their worst week since December. Despite this, U.S. stocks still closed mostly up on Friday as investors weighed improved consumer sentiment and warnings from Fed officials about high inflation. The Dow Jones Industrial Average rose by 0.5% to close at 33,869, while the S&P 500 gained 0.2% to finish at 4,090. The Nasdaq Composite, however, fell 0.6% to end at 11,718. For the week, the Dow dipped 0.2%, the S&P 500 shed 1.1%, and the Nasdaq fell 2.4%. Investors divided their attention between corporate earnings reports, economic data, and comments from Federal Reserve officials. The University of Michigan's preliminary report showed a rise in its index of U.S. consumer sentiment to a 13-month high, indicating a cautiously optimistic outlook for the economy. However, inflation expectations 1 year out also edged up to 4.2%, which some consider to be troubling for the Fed. Earnings reports from companies such as Expedia Group, with shrinking profit margins, have disappointed investors, leading to doubts about the consumer discretionary sector, which has been the best performing sector in the S&P 500 so far this year. Wage growth and stubborn services sector inflation remain a concern for policymakers, and high uncertainty remains with stock market valuations. The yield curve in the U.S. Treasury market has also been deeply inverted, with short-term rates trading above longer-term yields, indicating a potential recession. Despite these challenges, stocks have avoided deeper losses because Fed Chair Jerome Powell has not strayed from his view that a disinflationary process has begun. The stock market awaits next week's Consumer Price Index report for January, and many investors are wary of opening new long positions. And now let's dive into the latest news and updates about the commodities markets. In recent developments, we saw a rebound in oil contracts on Friday, with Brent and WTI jumping more than 2%. This was a result of the announcement by Russian Deputy Prime Minister Alexander Novak that production would be cut by 500,000 barrels per day, or 5% of the output. The crude prices reacted positively to the news, and it's clear that so far, Russian oil production has been relatively resilient. The move was made with the aim to improve oil revenues by narrowing the discount of Russian oil to Brent. As for gold markets, we saw an initial rally earlier in the week, but then it gave back its gains. At the moment, the market formed an inverted hammer, which is a negative sign unless we break above the top of it. If that were to happen, then we could see a rally towards the top of the previous candlestick. But right now, it seems more likely that we'll see more downward pressure. If we break down below the bottom of the candlestick, then it's very possible that we could be headed towards the crucial $1,800 level. As we move forward into the coming week, it's time to turn our attention to the most significant events on the horizon. Week is going to be an important one for investors, as it's packed with a range of economic events and reports. However, the most significant of all is the inflation data that will be released on Tuesday. The January Consumer Price Index (CPI) report is going to be highly scrutinized, especially after Federal Reserve Chair Jerome Powell acknowledged the presence of disinflation in the U.S. economy. Economists are expecting the headline CPI to have risen 0.5% month over month in January, which is a notable increase compared to figures seen in recent months. The Bureau of Labor Statistics also released new seasonal adjustments last Friday, which switched December's initial reading of a 0.1% monthly drop in headline inflation to an increase of 0.1% in the year's final month. While the monthly CPI figure is expected to have risen in January, The annual headline number is projected to come down to 6.2% from 6.5% the prior month, according to consensus estimates compiled by Bloomberg. During an interview last week in Washington, D.C., Powell stated that he expects housing inflation to fall in the middle of the year. He also added that there's an expectation that inflation will go away quickly, but he doesn't think that's guaranteed to be the case and it will take some time. On Wednesday, the government will release its retail sales report, which is expected to show a 1.9% increase over the prior month, following a 1.1% decline in December. This report is a good indicator of consumer spending, which is a crucial driver of the economy. On Thursday, the Producer Price Index will be released, giving investors a sense of how quickly prices are rising at the wholesale level. The PPI is expected to have risen 0.4% over the prior month, with an annual reading of 5.4%, down from 6.2% in December. On the earnings side, investors are entering the final stretch of the reporting season, with 69% of companies in the S&P 500 index having already reported their results. In the week ahead, investors will get results from well-known companies such as Airbnb, Coca-Cola, DraftKings, Paramount Global, and Deere. In conclusion, the economic calendar is full in the week ahead, and inflation data will be the most important event for investors. With a range of economic reports, earnings results, and other events, it will be a busy and potentially volatile week ahead. Now that we've discussed the current market trends, let's take a closer look at some of the hottest stocks making waves on StockInvest.us. With all the excitement surrounding artificial intelligence, it's no wonder that people are searching for the hottest AI stocks on StockInvest.us. And with Microsoft announcing its plans to integrate OpenAI's a chatbot into its Bing search engine, the buzz only continues to grow. On Friday, Microsoft's stock price dipped 0.19% from $263.62 to $263.10, marking its fourth consecutive day of decline. However, Bill Gates, the co-founder of Microsoft, remains optimistic and convinced that AI like ChatGPT will revolutionize our world. In response to Microsoft's move, Alphabet, parent company of Google, announced its own AI chatbot, Bard, which it plans to roll out in the coming months. On Friday, Google's stock price also dropped 0.62%. Meanwhile, C3.ai, an AI software company, saw a positive trend, with its stock price gaining 2.22% from $22.49 to $22.99. The company is working to capture a share of the $596 billion market opportunity for AI-powered software applications for enterprises and governments. Investors are always on the lookout for the next big thing, and AI seems to be Wall Street's current favorite. As major tech companies embrace AI, investors are buying up AI stocks, including C3.ai, whose shares have risen by roughly 130% in the past month. However, it's important to understand the difference between price movement driven by emotions and price movement driven by solid fundamentals. And to wrap things up, let's dive into our final topic. The next competition among the giants of technology has begun, with Microsoft integrating OpenAI's chatbot into Bing and Alphabet's announcement of its own chatbot called Bard. The race to advanced language learning models is heating up. Both of these AI tools have been trained on vast amounts of data to provide human-like written results, shaping the future of search engine technology. Microsoft and Alphabet are not alone in this race, with Chinese companies Baidu and Alibaba joining in, but the focus will remain on these American competitors. Microsoft's move with OpenAI is a strategic investment and a push as a first mover. But with less than 10% market share on desktops and virtually zero on mobile devices, Bing has only an estimated 3% share of the search engine market. Alphabet's position is more established, with Google Search having over 4 billion regular users worldwide and DeepMind's AI expertise integrated into Alphabet products. Google Search generates over $42 billion in revenue and makes up the majority of Alphabet's $75 billion in annual operating profits. The race is on to see who will take a slice of the lucrative search engine market, with Microsoft looking to gain back some share and Alphabet working to maintain its dominance. While Microsoft has made a strong start with its investment in OpenAI, Alphabet's deep roots in the market and AI expertise give it a strong position. It's uncertain who will come out on top, but this battle for search engine supremacy is sure to be fascinating to watch in the coming years. Thanks for tuning in to StockInvest.us. We hope you found this video helpful in your quest for informed investment decisions. Remember to keep an eye on a stock's fundamentals, financial health, industry trends, and any relevant information or events that may impact the stock price. If you have any questions or comments, feel free to reach out to us via comments or our social media channels. We'll be back next week with more analysis and insights, so stay tuned. As always, please keep in mind that trading involves a high risk of losing money and that you should speak with a financial advisor before making any investment decisions. The information provided on StockInvest.us should not be the sole basis for your investment decisions, and any use of the information provided is at your own risk.